Thanks, Melissa. Good evening, everyone. On behalf of Asian Markets, we welcome you all to the 2Q FY20 earnings conference call of Elgi Equipment Limited. We have with us today Mr. Jairam Vadaraj, Managing Director representing the company. I request Mr. Jairam to take us through an overview of the quarterly results, and then we shall begin the Q&A session. Over to you, sir. Thank you.
Thank you, Kamlesh. Good evening, ladies and gentlemen. Thank you for taking the time off to be with us. I will take you through our consolidated numbers for the current quarter in comparison to the second quarter of the previous year. Our sales, we compared to the previous year's Q2, we are lower to the extent of about 1.5% at the consolidated level. Our contribution margin has been slightly better at material cost level. Our EBITDA, which should have been, if we had hit the same revenue levels as last year, we should have had a contribution of EBITDA level of about 482. Our actual EBITDA was only 338. So I'm going to give you an explanation for close to 140 million in the drop in EBITDA. The biggest contributor has been our increase in people cost. All other costs have been at or lower than the previous year. If I take the people cost increase, there are two aspects to it. There is a regular growth for our business as usual, elements of people. And then there is the strategic thing, like I explained to you in the last quarterly analyst meet call. We are investing in Europe, and we continue to increase our investment in talent in Europe. And that's a big aspect of our investment and impact in this quarter's performance. I'm not overly worried about it because this is something that we consciously said that we're going to do, and it is in line with what we plan to invest as far as talent is concerned. So close to 53 million out of our 140 million drop in EBITDA can be attributed to strategic elements both in Europe and in the US. In our regular cost, we have got about close to 70 million. And out of that 70 million, the biggest element is the people cost in Pulfords. And that's not because people costs have gone up. Last year, we had only 2 months of cost because of the acquisition. And this year, this year we've got the full three months of impact coming in. So it's just a matter of getting normalized over the years. We've invested, we've added people in patents as part of building our business. And compared to last year, patents is beginning to grow this year, and we are quite happy with the traction it is gaining in the market. And I'm very confident that things are going to look up for patents and the US business. So this is a summary of our performance in the current quarter. Sales has been a challenge, and I will talk a little bit about that. At a consolidated level, India has dropped by about 2%, whereas the rest of the world has grown by about 6 to 7%. The markets have been very challenging in India across all verticals. There have been specific verticals where we have been running strategic initiatives, and those have performed really well for us. So while the business as usual performance in India has been not so good, far from our budgeted plan of growth, strategic initiatives have far exceeded our targeted levels of growth. As far as the rest of the world is concerned, I will start again from Australia. At a consolidated level, LG Australia, Pulfords, all the entities put together have been relatively flat compared to last year. But there was a slowdown in the Australian market for the last 2 to 3 months, but things are beginning to look up. We believe that there will be a correction in the balance of the 6 months of the current financial year. Southeast Asia was very muted. We've had some growth in specific markets, but it's not been to our budget. But we think the balance of the 6 months would be slightly better than the first 6 months of this year. Jumping over India into the Middle East, our initiative to go direct in UAE has yielded good results. We've gained some significant share in the market, and this is reflected in the fact that our sales has been far ahead of last year as well as far ahead of budget. Right. Moving on to Europe, our industrial performance through Rotair in Italy has grown, and it's continuing to move from strength to strength. I'll come back and talk about the portable business in the context of what we did in the U.S. Moving on to the U.S., like I said, the patents business has grown, and I believe that we are back on a growth trajectory, and we are expecting to see good results from patents in the future. USA Direct, which is non-patent sales to other distributors, has been flat. But we lost some big accounts by virtue of acquisition of some of our distributors by competitors. But we have some initiatives planned for the balance of the 6 months. We expect that we will be back on a growth path for the balance 6 months. In this financial year, like I explained in the last call, we have taken over the distribution business of Rotair's master distributor for portable compressors in the U.S. So our numbers today reflect the sales directly done by the U.S. subsidiary of portables made by Rotair. The sales performance of those portables has been relatively flat. It has not grown. We are going through the transition phase between the distributor and our own direct operation. We have built the team in place, and we're still continuing to add to the team that is going to eventually run the business. At the moment, our earlier distributor is helping us through a management contract to run the business, but eventually we will take over and run the business ourselves. And towards that end, we are preparing. So, as a consequence of a muted portable sale in the U.S., Rotair's portable sales correspondingly has been also muted. And there has been some other impacts which I'll talk about in the cash flow. So, if I step back and look at the future through the eyes of the current performance, all indications that we are getting about the Indian market is we don't see any big change happening in the next at least couple of years. It doesn't mean that we're going to drop, but I don't think the kind of expectation of growth is going to happen. We have gone back to the drawing board. We are looking at different strategic initiatives. It may take us a few months, but I'm confident that we'll come back with very strong initiatives in the market to compensate for the overall dullness in the market in India. As far as our expectation, the rest of the strategic markets, we are not changing our opinion or expectation. They continue to remain. The quarter-to-quarter variations that we are seeing are nothing more than just variations in the blurb, rather than any indication of trend. So we remain optimistic. the fact that we've been able to improve our contribution margin in spite of the markets being so competitive is a fact that we're beginning to gain traction. We are not giving things away in the marketplace. So I still remain confident about continuing to perform well. We need to adjust ourselves to the circumstances of the market in India. We didn't expect, compared to the call in the first quarter when I said things seem to be slowing down, I didn't expect things to drop as significantly and as sharply as they have. But this is the reality, and we will respond to this reality in the appropriate manner, and we're quite confident that we will. We've already initiated multiple avenues for bringing costs down, reining in costs appropriately without compromising on our long-term commitment to our aspiration. This has already started, and we are hoping in the next couple of months we'll start seeing the results of these initiatives showing up in our financial statements. During this quarter, by virtue of our taking over of the portables distributor in the U.S., we also acquired a lot of inventory, and that has put a dent on our working capital, which we had to fund. And the significant drop in the sales in India has also saddled us with a little bit of raw material that we will consume over the next, when we recalibrate the market, our production to the market realities. So as a consequence of all the working capital increases that have happened in the last 3 months, our net debt has gone up by about 100 crores. So in this, we are very confident in the next 3 to 4 months we will be able to bring that inventory back to reasonable levels. So this is just an aberration. So the debt in Q1, I don't remember the exact number, but compared to March 19, the debt position has gone up by 100 crores, but compared to Q1 of this year, I will give you the number. The debt position has gone up by about 50 crores, right? So it's even increase between the first quarter and the second quarter. So this is a summary of our performance. I'll be happy to answer any questions that you may have.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may enter star and 1 on your touchtone telephone. If your questions have been answered and you wish to withdraw yourself from the queue, you may enter star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, you may enter star and 1. Participants, if you would like to ask a question, you may enter star and 1. We have the first question from the line of Manish Goyal from Enam Holdings. Please go ahead.
Yeah, hello.
Hi Manish, how are you?
Hi. Fine, thank you so much, sir. Just if you can elaborate little bit more on, like in last 6 months, how like things have changed quite badly in terms of your outlook for India market. If you can elaborate a little bit more, like what have changed on the ground as per what your perception was at the beginning of the year, sir?
Okay. If you wind back to what we said in the end of the first quarter, we were beginning to see inquiries continuing to be very healthy, and they were continuing to grow at a pace that was consistent with our budgeted growth. But I had said that there was a little stickiness in terms of finalizing. People were delaying things. That was the status as of the end of the first quarter. But as the second quarter rolled in, not only did the conversion was sticky, but also the general level of inquiries have also dropped quite significantly. So it's a combination of both. I think there was a certain tentativeness, I would think, in the first quarter, which made them kind of wait. But I think that tentativeness converted into getting to the other side of the fence and postponing many of their investment decisions. So this phenomenon we have seen across all verticals of our business, and even our aftermarket, where is also another indicator of general industrial activity. We see a significant slowdown because many of our customers have reduced their shifts, which means maintenance requirements have come down, and therefore the aftermarket requirements have come down as well. So if you look at the first quarter, we did well compared to our aspiration and to our budget, and previous year we did well in aftermarket, and then the slide has been pretty significant in the second quarter. So all this is kind of indicative of the fact general capacity building activity has substantially slowed down. Right? Now, having said that, we've been running certain initiatives in specific products like our oil-free, where we have seen solid growth compared to even the previous year. I don't want to get into specific numbers, but we are very pleased with the way that we have grown that business. It is also indicative of the fact that we can possibly create those kind of niche initiatives in the other current markets that we are operating in as well. So there's some possibility that we can work out for the balance of the year.
Sure. Right, sir. And on the rest of the world, if you can, like you did mention about specific markets. So ideally for the rest of the world, you expect the growth, single-digit growth or double-digit growth? How do you see that?
We started off this year expecting double-digit growth in the rest of the year, the rest of the markets. I would say Australia will be close to double digits, maybe not a big double digit, but it's possible that they will have at least a high single-digit growth. Southeast Asia would again be a single-digit growth, maybe a high single-digit growth. Our Middle East will be a significant double-digit growth. Europe, our business in Italy for industrials is got double-digit growth as of now, and I expect that will continue. As we build our initiative, as we build a team and roll out our initiative in the rest of the year in Europe, it has to be double-digit growth because the starting point is zero, right? So there will be a significant growth. As far as the U.S. is concerned, I expect patterns to have a high single or a low double-digit growth for this year. As far as Elgi direct through other distributors, I would say, other than an initiative that we are working on, I would say that we would have a high single-digit growth. So that will be a summary across markets.
Okay. Thank you so much. And also a bit confused on what you mentioned about the distributorship, what we have taken over Rotair. So basically, there was a separate distributor of Rotair in US, which now we have taken over. Is that right?
No. Manish, I explained this in the last call. There was a master distributor for Rotair who was selling exclusively the products, Rotair's portable products in the U.S.
Sure.
So we have taken over that business. We didn't buy the distributor. We've just taken over the distribution business in our subsidiary in the U.S.
Okay.
And the distributor, the management team of the erstwhile distributor is helping us run the business during a transit period till we build our own capability to run the business, right?
Sure. Okay.
So right from May of this year, the revenue and profit from the business is accruing to LG. Of course, we are paying them a fee, a management fee for helping us run the business for a limited period of time.
Sure. Okay. And on the cost rationalization, what kind of improvement or cost cutting can we see? As you said, it will be visible in couple of quarters. So, would you like to put some number?
I wouldn't like to put a number yet, Manish, but in another month, we should be able to have a reasonably good idea of what will be those numbers.
Okay. And last question, in standalone, the other income has gone up. So is it that this quarter we have received dividend from the subsidiaries?
Right. It's dividend from ATS.
How much would it be?
It's 7 crores.
7 crores. Okay. Fine, sir. I'll come back in the queue, sir. Thank you so much.
You're welcome.
Thank you. Ladies and gentlemen, to ask a question, you may enter star and 1. We have the next question from the line of Ranjit Shivaram from ICICI Securities. Please go ahead.
Hello?
Mr. Shivaram, please go ahead with your question.
Yeah, hello. Am I audible, sir?
Yes.
Yeah, good evening, sir.
Good evening.
Just wanted to know, we are hearing a lot of slowdown in terms of private sector and the liquidity crisis. So, what is your view? How do you see this? And is there any impact to our growth because of this? And what are the signs we should look at for the uptick or what? And has this tax rationalization or reduction improved in at least people converting inquiries into orders, things like that?
I'll try to answer as best as I've understood your question. Our business is capital goods, which is closely linked to capacity creation in the economy. A big part of our revenue is towards actually building the capacity of a customer's plant. Now, for us, the main indicator for capacity build-up is the utilization of the current facility of the customer. Now, that will show up first in our aftermarket business. Now, if our aftermarket business starts improving, it means then all our customers' production capacities are going up, and then therefore they will be soon coming in for additional capacities for compressors. So that is a clear indicator internally for us. There are, of course, external indicators of capital formation in the economy, investments by government on major projects, but how they will trickle down into compressor demand and when they will trickle down to compressor demand is very difficult for us to predict. So there are macro level stuff that we can't use to predict precisely, but micro within our own business for us is aftermarket.
Okay, so what are the signals that you are seeing? Are things improving, or is it still in the same status quo? What's your reading of the market?
So if I have to interpret the market through the lens of our aftermarket business, it's pretty bad, because our aftermarket business is not grown, and it is languishing below last year's levels. And the trend over the last 6 months clearly indicates that customers are using our equipment less, which really means that their production has also come down. So unless we start seeing an uptick in that, we won't have an optimistic view of the market.
Okay, and again, looking at Europe and Australia, so what's the outlook you are forming up? And is Brexit anything to worry about for us, or is it just a normal disruption?
In markets like Europe, where we are nothing, our share is so small, the headroom for growth is so high. Turbulences at the top of the ocean should not make any difference at the floor of the ocean.
Okay, so you don't see any risk because of this overall challenges into our growth. Is that interpretation right?
Yes, because if you look at it, the Italian economy has had the most challenging period in the last year and a half, whereas we have grown in double digit in that market.
Okay. Sir, lastly, this water well, how has the water well market been? Was that better than expectation or below expectation?
It's far below expectation. I think we can reasonably say it has been far below expectation across the board for all players.
What should we read? Is it kind of 1 year tough period? Or when can we see this reversing the overall market?
Well, if I had a magic glass through which I can look and predict, then it would be wonderful. I'll be making money somewhere else. But at the moment, when we look at all the indications, talking to customers, they are not seeing any time frame, because you can't say it is now post-Diwali this is going to happen, or post this is going to happen. There is no post anything. So there's a newly elected government, so you can't say post-elections that something is going to happen. So Diwalis come and go. So I don't think there's anything indicative of saying post this. I think fundamentally the economy, I believe, is going through a cycle. It is taking a pause on consumption. Income and ability to spend has to increase, and then there will be back into a consumption cycle. So this is my kind of interpretation of the whole thing. So it's very difficult to say by which time. So we are saying maybe a couple of years of subdued, maybe 4%, 5% growth of the economy, and then maybe it starts climbing again.
Okay, sir. Thanks. I'll join.
Thank you. Ladies and gentlemen, to ask a question, you may enter star and 1. Participants, if you have a question, you may enter star and 1. We have the next question from the line of Manish Goyal from Enam Holdings. Please go ahead.
Hello. Just to understand, you did allude on the improvement in the gross margin. So do you see this? Just want to know what's driving that improvement, and do you see this sustaining?
I think what is driving it is, one is there's been a softening of commodity prices in the last year and a half. So to the extent that expected price increases that we anticipated or projected did not happen.
Right.
And our international sales as a percentage is higher in the current period, which is our price realizations are far better in those markets. So that's a secondary factor.
Okay.
So will we be able to sustain it? Yes, we should be able to.
Okay. And this.
And Manish, you need to remember that we have achieved this contribution with a lower contribution of aftermarket, which is a more profitable business.
Yeah, in fact, that is what.
So when the aftermarket kicks in and the economy grows, our margins should definitely improve.
But what kind of decline have you seen in aftermarket in terms of aftermarket?
I don't want to talk about specific percentages, Manish, but it is lower than last year. It was very good in the first quarter.
Okay.
But in the second quarter, it is lower than last year.
Okay. And
Okay.
And on the capex side, on the motor facility, how is it progressing, and any other capex plans?
Well, the motor plant capex is mostly done. There's a few balancing equipment, but it's still within the overall number of 18 crores that I had mentioned earlier.
18 crores.
18.
Yeah. Okay.
18.
Sure.
So that we have already started trial production of motors. We're putting them into the field. There are a couple of equipment that has been delayed by a vendor. We've had issues of delays. We are trying to get that resolved. Once that is in, then we should get into regular production very soon.
And overall capex, sir, for current year?
Overall capex, I think bulk of it is going to be capex that was committed last year that we need to complete. We'll probably be spending about 20 crores besides the motor plant.
Okay.
But
and
these are all machine tools that have been bought and advance paid for last year. In terms of, we're really not doing anything that is we're not initiating any big capex this year.
Okay. And on the debt side, by year end, what is your expectation? Should we back to the previous year level? So the increment 100 crores, what we have seen in last 6 months, should we be able to kind of reduce it?
If I look at the biggest contributor for the increased debt is inventory. It is not, from a working capital point of view, it's inventory. Now, of that, one of the biggest chunks is portable inventory that we picked up from our distributor. That is not going to be completely brought down to zero levels in the next 6 months. So I expect maybe half of that inventory getting utilized over the next 6 months. India inventory, we are quite confident that we will bring that under control. It is just one planning cycle that we need to exercise control over, and we'll start seeing the result. So out of the 100 crores additional, my estimate is half of it can be recovered. Very conservatively, half of it can be recovered in the balance period.
Sure. And the last question on water well, you mentioned that market has been bad, but what probably we see is from the Cummins industrial numbers, the compressor sales have been quite, compressor sales to water well has been quite good in Q1 and Q2 as well. So just wondering that have we lost market share or...
Well, Manish, we have a lot of stock of engines. So you should ask the competitors what is their stock of engines.
Got it. Thank you so much, sir.
Yeah.
Thanks.
Thank you. Ladies and gentlemen, to ask a question, you may enter star and 1. Participants, if you have a question, you may enter star and 1.
Hi, Jai, Kamlesh here. Sir, can you just share some more insights about how the BCG marketing initiative programs progress? Is there any need to be tweaking that as well, and how has been the results thus far?
As far as that project is concerned, it's been a resounding success for us, Kamlesh.
Yeah.
We had originally planned that the ROI on that project was about 2 years, and we have more than adequately recovered that investment. Now, what we are doing is we are taking it to the next level through our own internal initiatives, and those are the special kind of initiatives that we are working internally. So,
and how has been the experience in the global market? We were supposed to launch phase 2 of that.
No, we've done it in the U.S. It's not in the global market.
Yeah, U.S.
So the fact that we are beginning to see traction at patents is a result of that initiative. And we're waiting to see. There's been a bit of a delay in seeing the results in Elgi direct, which means the other than patents territories, but we're quite confident it will come. Like I said, we lost a few big accounts because they got acquired by competitors.
And any major cost of that still need to be amortized, or is already being largely funded?
We have still some costs to be incurred up to March. But it's about 5 crores. Okay.
Secondly, sir, coming to the Indian markets, you highlighted across the segments the market was dull. Any specific color you can put up to, say, infra, steel, cement, auto, or maybe on the consumer industry like pharma, chemical, FMCG?
I think cement has been strong. It has done well. The chemical process, specifically in chemicals, it's done well. Auto has been down. Textiles have been down. General engineering has been down. Pharmaceuticals has done well for us because of our specific initiatives that we are running for oil-free machines. So, but overall, I would say this is the breakup of verticals.
And sir, anything about steel and railways?
Railways has been business as usual. It's a function of what is the allocation of the budget by the government, and that's kind of just steadily plods along. I wouldn't say anything spectacular about railways. It is just there.
And steel? Hello?
Yeah.
Steel side?
we don't see any much of activity in steel, at least not from our side. No.
Okay. And, sir, anything in terms of the other markets? I think we are not touched on Brazilian and other markets. So any intake out the business has been there?
Brazil has grown compared to previous year, but it's still very small. Our biggest challenge in Brazil is to collect our old outstandings. Our entire focus is on doing that. But it is grown and it is done better than last year.
Okay. Fine. Melissa, any further questions?
Sure. One moment, sir. Let me check. We have the next question from the line of Amit Anwani from ICSA Direct. Please go ahead.
Hello.
Hi.
Hi, sir. Could you share the breakup of rest of the world and India for this quarter and YOY? And if you could elaborate more on the growth outlook for the whole year on a consolidated basis, and any color on the margin for this year, FY20.
Just give me a minute. So, for Q2, our rest of the world business was about 45%.
How much? 45?
Yeah, 45% of the total. India was.
Okay.
I expect that the balance of the year will be the same, with probably the rest of the world contributing more than India. As far as margins at gross profit level, we are confident that we will continue to maintain it. There is no problem. In terms of revenue, for the rest of the 2 quarters, I think it's going to be at the current level. I don't see it being significantly better than the current level.
You mean to say at the level of YOY or the H1?
Current level of Q2.
Okay. Thanks. Yeah.
Thank you. Participants, if you have a question, you may enter star and 1. Ladies and gentlemen, to ask a question, you may enter star and 1. Mr. Kotak, do you have any more questions from your end?
Jayram, just one thing. Are we through with the manpower cost? You said the new initiatives, the strategic one and all that. So should we go by this as the run rate, or how it will be normalized?
No.
The employee cost.
I explained to you, we are going to increase our cost in Europe. The rest of the world will be in a steady state basis. Now, our estimate for Europe. So we have estimated over the next year and a half, we will be investing close to about 10 million euro. So that will be close to about 80 crores. But we will also begin to see some revenues coming in as part of that. So the manpower cost in Europe is going to continue to increase till we reach that level.
Okay. And sir, looking at the overall state of the things, do you see our 3 years, 5 years target, what we had made? So is there any need to rework the same?
No, we are going to stay focused on this. We will, of course, take a lot of short-term measures to strengthen our position wherever it needs to be done. We can't lose sight of the long-term focus. The fact that we have built this international business needs to be sustained. It needs to be nurtured. We have also learned how to engage and get stronger in India. We will continue to use that learning to get deeper into Indian market, into the Indian market. So I wouldn't change the formula in any significant way. I will stay the course, while at the same time strengthen the company's short-term stamina to stay the course. So that's really the recipe. I don't think we should pretend that things are so bad. They're not. We're going through some turbulent times. We just need to get stronger.
Okay.
So even if you look at Europe today, our current number already is people cost are already pegged in to the tune of 240, almost to the extent of 3 million euro. So when I'm saying from 3 million we're going to go to 6 million, it's not a big change from what it is in terms of what it can bring in, right? So, and if we go by the experience of what we've had in Italy, which is still growing, if we can replicate that in the chosen markets in Europe, it's exceedingly doable.
Sure.
If India had grown, and we would have, all these adventures wouldn't be looking so bad, Kamlesh.
Mm-hmm. Mm-hmm.
Yeah.
Mm-hmm. Right. Great. Melissa, any further questions?
So no participants in queue as of now.
Great. So, sir, with that, we conclude the call. Special thanks to Mr. Jairam and his team for providing us the insights about the company's business plan and financial performance. With that, we conclude the call. Sir, any closing remarks you want to make?
Nothing specific, Kamlesh. I think the thing is, I know it's disappointing for everyone, but I would say that considering the numbers that I've seen of other companies, we're not doing so badly. A big part of our cost today is because of initiatives that we are driving to grow our business internationally. I think we need to stay the course and make that happen.
Sure. Great. Okay. So with that, we conclude the call. Thank you, everyone, for joining by. And
Thank
have
you.
a great evening. Thank you.
Thank you, gentlemen.